Bitcoin shocked the market this week after dropping sharply to $60,000, triggering fear, panic selling, and renewed debate about whether Bitcoin is truly ready to behave like a mature asset. This decline came despite strong fundamentals. Spot Bitcoin ETFs are live. Institutional demand continues to grow. Regulatory clarity is improving. Long-term adoption trends remain intact. So why did Bitcoin still fall so hard? According to Anthony Scaramucci, founder of SkyBridge Capital and a longtime Bitcoin advocate, this move was not a failure of Bitcoin. He described it as a normal correction in an early-stage asset. Speaking on CNBC's Closing Bell Overtime, Scaramucci explained why volatility remains unavoidable, why ETFs have not eliminated price swings, and why this dip may actually signal strength rather than weakness. In this video, we break down what caused Bitcoin's drop to $60,000, why positive news has not stabilized price, how early-stage adoption affects volatility, the real role of ETFs and institutions, what regulatory clarity could change, and why Scaramucci bought more Bitcoin during the crash. Let's begin with what happened in the market this week. Bitcoin entered the week trading comfortably above key support levels, with many investors expecting consolidation rather than chaos. Instead, the market experienced a sharp sell-off followed by a fast rebound, which is typical Bitcoin behavior. At one point, Bitcoin dropped to $60,000, wiping out billions of dollars in market value within hours. The move triggered large liquidations, shook short-term traders, sparked fear across social media, and revived bearish narratives claiming Bitcoin had lost momentum. What confused many investors was timing. The drop did not occur during negative news. In fact, the broader narrative around Bitcoin has been improving. ETFs continue to attract long-term capital. Major institutions are increasing exposure. Governments are moving toward clearer regulatory frameworks. Bitcoin remains one of the best-performing assets of the past decade. Yet, despite this, price declined sharply. Scaramucci acknowledged that the move was uncomfortable, especially for newer investors, but emphasized that this behavior is consistent with Bitcoin's historical pattern during its adoption phase. Scaramucci made one point very clear: this was a normal correction. According to him, Bitcoin is not broken. The market is behaving as expected for an asset still being adopted globally. He rejected the idea that ETFs alone would suddenly turn Bitcoin into a low-volatility asset similar to bonds or blue-chip stocks. He explained that Bitcoin is not just digital gold and not just money. It represents a new type of financial technology. Because of this, the market is still learning how to value Bitcoin, how to price its risk, how institutions should allocate to it, and how it fits into global portfolios. That process takes time, and volatility is part of it. Scaramucci emphasized that Bitcoin remains an early-stage asset. He described Bitcoin as a form of monetary technology with characteristics of money, gold, and a decentralized network. Early-stage assets typically experience sharp corrections, emotional trading, rapid sentiment shifts, and large price movements in both directions. He compared Bitcoin's current phase to early internet companies in the 1990s, emerging technology stocks before mass adoption, and financial instruments before institutional frameworks. Until adoption reaches a broader demographic, volatility will remain. Scaramucci also highlighted who currently owns Bitcoin. According to him, most Bitcoin holders are younger investors, while older and wealthier investors continue to prefer traditional safe haven assets such as gold and silver. This helps explain why precious metals performed strongly earlier this year, while Bitcoin struggled to maintain highs during risk-off market conditions. Older investors typically value stability over growth, are cautious with new technologies, and prefer assets with centuries of history.
Bitcoin, by contrast, is only about 15 years old, remains misunderstood by many institutions, and is still waiting for full regulatory clarity. Until this demographic shift occurs, Bitcoin is likely to remain more volatile than traditional safe havens. Despite the approval of ETFs, Scaramucci believes regulatory uncertainty continues to limit Bitcoin adoption. He pointed to the need for clear United States legislation, defined custody rules, and transparent compliance frameworks. Without clear guidance, banks hesitate to offer Bitcoin services, institutions limit exposure, pension funds remain cautious, and large pools of capital stay on the sidelines. Even with ETFs available, many institutions are waiting for explicit government direction before committing at scale. According to Scaramucci, once regulatory clarity improves, institutional confidence will rise, volatility will gradually decrease, and long-term capital inflows will accelerate. Until then, uncertainty will continue to influence price action. Many investors expected Bitcoin ETFs to significantly reduce volatility. Scaramucci pushed back on that assumption. He explained that ETFs improve access, increase liquidity, and enable institutional participation, but they do not eliminate market cycles. ETF flows can still amplify panic-driven selling and remain sensitive to broader macroeconomic conditions. However, Scaramucci noted that the recent correction was smaller than comparable declines in previous market cycles. In earlier years, a similar move could have pushed Bitcoin much lower. This time, Bitcoin held near its 200-day moving average, suggesting growing